Last Monday, investors woke up to a sharp sell-off in the equity markets. But by the end of the week, the major averages nearly came all the way back, including the NASDAQ, which was only down fractionally by Friday's closing bell. Joining us now to give us some perspective on the tech sector, Doug Clinton, Deepwater Asset Management managing partner. Doug, good morning. I mean, among the many things going on in markets in recent weeks has been a little bit of a rotation out of some of the bigger crowded trades that has included some of the mega cap tech stocks. Where does that leave us right now in terms of, I guess, creating your hierarchy of opportunities?
Mike, it has been a volatile week. It's been a volatile month. And our bet right now is that the worst of the volatility for tech, at least for this particular correction, is likely over. And we've referenced this data before, but I think it's really important. From 94 to 2000, so going back to the last technologically driven sort of boom period we've seen in markets, there were 11 corrections in the NASDAQ over that period of 10% or more. And then Monday, when we had that yen carry trade sort of blow up, the NASDAQ hit down about 15%. And so when we look at that historical data, we actually think it's sort of a signal for psychologically just how do investors process corrections when we're in these technologically driven booms. And it feels like down 10, 15% from peaks is sort of this clearing rate where you get a little bit of the exuberance out of the market. And I think that's exactly what we've had happen right here.
Although when it comes to, let's say, semiconductors as a group, down 25% last week, I mean, from peak to trough, and then still down 20%, it just seems to be a little bit of a rethink of the AI investment cycle, when we're going to get payback on that. How is that playing through to the stocks that you focus on?
It is a little bit of a rethink. We've had more of this conversation about when will we start to see meaningful revenue from all of this CapEx that's going into AI, hundreds of billions of dollars likely over the next few years. And the reality is this for us. Number one, when we think of when we're going to start seeing payback, I still think there's this mismatch between the companies who are actually investing in this technology and the investors on the other side. I think investors are hoping to see payback, over the next year, 18 months. And if that's the case, they're going to be disappointed. I think we won't see meaningful AI revenues for a lot of these companies for a year plus. And I think the companies like the Mag 6, the mega cap tech companies who are driving this boom, they have longer horizons in terms of how they're thinking about payback on this technology. So that mismatch is always a risk. When we look at where we're trying to play it, Taiwan Semi has been a name that we've owned now for almost a year. It's a name that we've liked for a while because when we think of this chip revolution, everybody has to use TSM to build these advanced AI chips. And just last week, Taiwan Semi posted their July revenue numbers up 45% year over year. It was better than investors were expecting. And it was an acceleration from June at 33%. So the demand for these AI chips is still strong despite what the stocks have been doing.